Welcome, everyone, to another exciting episode of the None of Our Businesses YouTube show and podcast, where three accountants talk about the latest in business news, all from an accountant's perspective. With me, as always, Jack DiMatteo.
Hello, everyone.
Charlie Zygmunt.
Hi, everybody.
And I forget to say it most times, but I'm Ty Carr, spelled Ty, but I just say Ty. Well, what are we talking about today? Today, from Accounting Today, the IRS is testing a secure transcript technology for tax pros. We are hopeful this should make figuring out what you filed and didn't file a lot easier. And Amazon buys MGM Studios. We're hoping they keep their treasured library intact and well served. WeWork posts a $2.1 billion quarterly loss. Would you be surprised to hear there are restructuring charges, impairment, and other unusual items in there? And finally, house flipping needs to be regulated. Does it really need to be regulated? Just to avoid people from selling to flippers at too low of a value or price. Well, let's get into these topics. We'll kick it off today with Charlie.
All right. So I've got an article from Accounting Today called IRS Tests Secure Transcript Technology for Tax Pros. And so what's happening is that the IRS is pilot testing a new technology that lets tax professionals request transcript data through an interface, and it helps them to kind of get that information more easily than maybe having the client request it from the IRS and then wait a long time for it to come through the mail, maybe. And so it's one of a few different things that they're doing. They said that it would help with identity thieves and to help kind of manage both hackers and identity thieves to have that information transmitted securely in a system that they can, put a bunch of funds into. The Biden administration has proposed a bunch of funding to upgrade its technology, and this is one of those efforts. And it's part of a multi-year plan that was announced in 2019, where the IRS is trying to kind of upgrade their technology. And it's made available to a bunch of third-party vendors. So what's going to happen is you won't just see IRS having this site. You'll see basically third-party vendors coming out and integrating it in their own ways. And so I wanted to get your guys' take on if this is the type of need that is better serviced by like a software as a service company, or if instead of that, maybe you think that the government will be releasing APIs for more different types of things in the near future. What do you guys think about that?
This is fun. I think this is a terrific idea. And I think this automation has been a long time coming. I know there's been a couple of things I've gone out to the IRS website on, and they'll kind of tell you right there that, these are some preferred vendors and this is where you can go to download these things. So I kind of think they're pretty wise in what they're doing, probably partnering with some of these private sector services, software as a service providers, because they're probably getting, a better bang for the buck. They've got some options. They're not all in on one vendor, and kind of forces those vendors to keep making improvements or enhancements. It doesn't turn into one of these things where, the program was great when they rolled it out, but it's had minimal done to it in 5 or 10 years, and now it's way behind the time. So, there's a lot of things to like about this article. I think it makes a lot of sense to, make it easier to get access to that information, make sure that information is secure. And I like the idea of a public-private partnership. I mean, it's, let's face it, that's probably not the government's strong suit. Do we really want them investing in software solutions, or do we want them partnering with the best of breed? So, I like the idea.
Yeah, I think it's a great thing too. As a former tax person, tax pro, I would say that the general public may be surprised at how often their fellow taxpayers just don't remember what they filed previously and don't know what was filed or not filed. And sometimes it's because they were relying on employees, if it's a business, or they were relying on their outside tax firm, and so they're confused about exactly what was filed. So that's kind of the context of why transcripts are there and why they're important. And historically, it's not super easy to get it. And so I think anything that streamlines that process, where a taxpayer and their tax professionals can get at that information really quickly, can makes the whole thing easier. And from on behalf of the American taxpayer, I think streamlining the process that taxpayers use to figure out what they filed previously and what they need to file should encourage better compliance over time as well, you would think. So I think it's a win-win-win all the way around for everyone to do it this way.
Yeah, I agree completely. And I think it also harkens back to a point we made on previous podcasts, just about how if the government has all of the data that is in your tax return, that should be available to the user. And this, I think, is a one step closer to that. So it'll be interesting to see how it plays out. Do you have another article we can talk about, Jack?
Yeah, one of those companies everybody loves to talk about, Amazon. Amazon made their biggest purchase since second biggest purchase in history, next to their Whole Foods purchase, and they bought MGM Studios. So they're trying to up their game with the streaming wars. Again, I think we've had this conversation on this show in the past, talking about how all these types of things get better for us as consumers. The different streaming content. You don't have stale content. They're buying MGM Studios, so that's access to a ton of content. I guess the only thing that I would hope is they treasure a lot of the films that they're going to get in those libraries, a lot of the shows and things of that nature that they pick up and preserve over time. But I think the more we hear of these things with these streaming sources, at some point, everybody hates their cable company, regardless of who it is. And I think the more options we have in some of these big powerhouses up in their game and being able to offer more content via streaming, more power to it. But it's unfortunately, I think the ones that are going to fall by the wayside are a lot of these studios. So I guess my only concern with these things is I hope that these acquirers, realize what they're purchasing and kind of keep those treasured libraries of films and shows intact for future generations. But on balance, I think this is a good thing for the consumer. What do you guys think?
I think it'll be interesting to see what does this bode for the American movie-going experience, right? Because here we have another streaming services buying out MGM Studios, and it seems, we know during the pandemic that a lot of movies were kind of straight to streaming, and so will there be a return to the box office? Going to the actual theater, or is this a sign of really the way movies are going to be distributed in the future won't primarily be that we all go to the big stadium kind of theater and sit in front of the huge screen together with popcorn and all that kind of thing. So I think there is a story there to see how that unfolds. And part of the answer to that, there's an interesting side story to this deal I saw in the Wall Street Journal that so apparently there's this unusual relationship between MGM Studios and now Amazon and the James Bond franchise, that apparently the characters of James Bond, including James Bond himself, are owned separately by a brother and sister that are kind of elderly now, but the sister is actually named Miss Broccoli and the brother is named Mr. Wilson. And so Miss Broccoli and Mr. Wilson own the characters, but MGM owned the rights to produce the movies, I guess, if I understand that correctly. And so Miss Broccoli and Mr. Wilson were insiders to the pending MGM Amazon deal. And, we're knowledgeable that this was going through a few days before it went through. But apparently this brother and sister duo have, they're on set when James Bond movies are made. They have the right to choose. They actually, I guess Miss Broccoli actually handpicked Daniel Craig to be Bond. They approve a lot of details in the movies, and one of the details that I think what I read was one of the things that they put forward is that the next James Bond movie has to come out in actual theaters. So to my question that I'm posing, Miss Broccoli and Mr. Wilson are holding the fort on that issue. They're making sure the next James Bond has to be released in an actual theater. At least for now, that was the deal. So yeah, interesting side story to this MGM Amazon deal. There's a third player or a couple of third players in the mix there as it relates to the Bond franchise anyway.
Well, it's good to hear, because honestly, that would be the fear for the consumer, is that a money hungry, gigantic corporation would take good intellectual property and run it into the ground. And so you need these people like the Broccoli to get in there and really make sure that the integrity is there. So I thought that was interesting. The other thing I thought was interesting is that the article talks about I think they called it a flywheel effect, but this idea that Amazon buys a bunch of synergistic businesses like this in an attempt to create an effect that where basically if you're on there looking at your Amazon Prime things to watch, that you might switch on over and shop and do all these other things. And so I think that's kind of an argument. I don't know that that's an argument for or against the consumer, because on the one hand, it's kind of monopolistic, but on the other hand, it's like, well, if you're using both services, are you maybe better off for that, synergy? But yeah, thought that was kind of an interesting characteristic.
So Ty, you bring a great point up. My goodness, the iconic dinner and a movie date could be something of the past. I didn't really think of that, but yeah, you're right. I mean, these patterns change, and with the pandemic, it's kind of an easy pattern to get out of. Charlie and I were talking a little bit before we got going. We were talking about the pro sports during the pandemic, and I think people got in the habit of not watching them anymore. And I don't know that a lot of those audiences come back. So, yeah, it'll be kind of interesting to see what patterns hold true over the long term. Maybe that it would be a thing of the past. But hey, Charlie, do you have another article for us this week?
Yeah, I've got a perfect one. Just speaking of patterns holding true for the long term. So WeWork, the article I found is in Yahoo Finance, and it's called WeWork reports a quarterly loss of nearly 2.1 billion with a B ahead of its public listing. And so the article kind of delves into what that loss really meant for the company. And so it talks about how it was hit with some restructuring charges while it prepares to go public. It said that, but that the operational parts of the business, like occupancy, had ticked up, and so they were starting to see a recovery. But it had some unusual items on its financial statements, which I won't go too far into detail, but we'll say that it incurred some restructuring costs. It had an impairment charge, and it had a settlement with the owner of WeWork's, Adam Newman. And so basically the article kind of uses the fact that it has had these other things to make a headline. And so it's like really making a big deal out of this big loss. But then when you dig in, you figure out that a lot of it is not recurring in nature. And we're kind of conventionally taught as accountants to focus on the operating section of the income statement, at least for the sake of, predicting future cash flows. And so I think it's kind of interesting that a lot of the things that we're talking about would have been priced into the price at the time of the IPO because they're now known. And so if the value that all the investors are trying to get is all about the future cash flows, and if all the things in the article are not going to happen again, theoretically, then it's kind of like, is there even a story here? And so I kind of want to get you guys' take on whether or not you think, whether or not it's worth discussing when a pre-IPO company has unusual items that probably aren't going to repeat anyway. What do you think?
Yeah, I think I think that's a good analysis of, what really matters from a valuation standpoint. The other thing I wonder about is I don't know what kind of value they have on the balance sheet related to relationships and lease agreements and that sort of thing. And so the fact that some of the unusual charges or impairments, makes me wonder if there is some decline in value that's associated with that piece of the unusual items. But otherwise, like the restructuring charges and things like that, if it's truly, if that is being reported in good faith, items that are truly one time or unusual or things that are not likely to repeat, then yeah, you would think from a valuation standpoint, it kind of gets set aside in terms of evaluating the future prospects of the business for sure.
It's funny. We're talking through this. I mean, even the article, trying to read through it, and what they were trying to tell you was kind of hazy and hard to explain. So that was kind of, when you look at these pre-IPO companies, I mean, I would think that would be at the point where they're printing money quarter after quarter after quarter, and everybody's looking to jump on board. It's like nothing says maybe it's not the right time for an IPO, like a $2.1 billion loss out of your IPO. So, like I said, you can't even wrap your mind around what the article's trying to tell you, and the fact that they're in this pre-IPO stage and they seem to already have, some serious problems. Proceed with caution, and like I say, I think it's just these workspaces. It's going to be it's it's a tough space to begin with. And so it just seems like, just even in the nature of the way they wrote the article and they're trying to explain what's going on, they're almost like they're trying to hide something. So, I mean, I would think at this one, this is definitely buyer beware.
Yeah, I'm with you 100%. I think it seems questionable, and their history of just I don't know if everybody knows about this, but we've talked about on podcasts just about some of their reports that they've put out, maybe having questionable connections to reality. And so, yeah, it'll be interesting to see what happens. I just want to keep it on everybody's radar. And yeah, so do you have another article we can talk about, Jack?
Sure do. This next one's real interesting to me because I don't know if I've mentioned it on this show or not, but I'm actually a house flipper, and in the article they talk about two types of house flippers: the one that actually take title, fix it, repair it, and resell it, which is the kind of house flipper I am. But some of these people in this article, if you ever see the hotel or airport seminar advertised, get rich in real estate, I think they're probably talking about some of these other ones where they'll go out and they will secure a property, and they're talking that they don't even take possession of it. They will buy it for a very, very favorable price, and then they'll sell it to a fix it up and flip investor like myself. I think there's a lot of work involved with this, but I don't know. I'm kind of hesitant when I see an article like this because I'm having a hard time believing that there are that many people out there willing to sell somebody with a line of a bull a $100,000 house for 20, 30, 40, or 50,000. So, the article talks about how these cities are going to go in there and they're going to crack down, but it's almost one of these things where it's like you could only protect somebody from themselves so much. If they have a house that, information is readily available these days. I mean, if you're out there selling your $100,000 house for half the value or less, I mean, is it really something that, do we really need the city to come in there and crack down on these things? Or isn't it, at some point, people, they're adults. I mean, where are these people when I'm looking to buy a house? Because I sure don't find them. I just think it's another one of these things where, every time we find a perceived wrong in society, right away, somebody on a local or state or federal level seems to feel like the need to step in there and save people from themselves. But I mean, if you've got a $100,000 house that you're willing to sell for $30,000, I guess from my perspective, that's on you. I don't know how much we need to go in there and crack down on that, but was kind of curious to see what you guys thought of this article.
Yeah, I mean, I agree with your sentiment on that because, I mean, the problem with this kind of well-meaning type of, trying to help people out kind of thing is that it could very easily backfire. I mean, in the scenario that you're talking about, like if somebody had $100,000 house, and here I don't know about other areas in the country, but here in Portland, there's no such thing as $100,000 house. So in the Portland metro, or even in all of Oregon that I know of. So yeah, I mean, just to make this conversation a little more relatable, let's say that somebody has a $400,000 house and they want to sell it for, 300,000 or 200,000 or whatever. Right. I mean, first off is that often, most, if they don't own the house outright, what I should say, right, you've got the bank in there, right? So the bank's not going to let them do that if that's, if there's an issue there for first off. But second off, if they own the house outright and they're doing that, these helping hands, how do they know that person doesn't desperately need that cash more than they need to, right? I mean, that there could be a very good reason for that. They need out of that area. They need to move on. They inherited the property or something, and they need the cash way more than they need to get full value. And that should be their right. They shouldn't have to not get the cash that they're trying to get right now because somebody else says, well, you're selling too low a value. We're not going to let you sell it. I mean, that's crazy. So yeah, I don't go for that. Even as liberal as I am, I don't go for that kind of regulation.
Yeah, I'm with you. I think especially with something that, like you said, just to touch on it again, it's like there's an entire RMLS service and various other services where a value is clearly laid out, and it's questionable if that's right. But if you go way under that, it's probably questionable. So I think, yeah, the system should the place to stop this kind of problem is in contract law and in escrow and in how these transactions get handled, but not in, stopping people from doing this. Because that's part of having a free market, I think, is letting people make what might seem to you to be a bad choice. But you don't know until you're in their shoes. So.
Ty, you brought up something that I had forgot to mention because I thought that same thing. Yeah, if they still owe the bank's not going to let them do it. So there's that. These must be houses they own free and clear. But to your point, there's always another story there, and they talk a little bit about how a lot of these houses are in complete disrepair, 30, 40, 50, 100,000. I mean, if you're in the Portland market, $100,000 worth of repairs, and a lot of times, and to your point, I have a friend that will. He goes up to the corner bar and he lives in a suburb that's probably not the greatest anymore, but a lot of people will see him up there, and they have parents that are in nursing homes or have passed, and they have homes in this area, and the reasons are a lot of what you just said. A lot of people, it might be worth this after you put these repairs in, or they might it could be a hoarder, it could be kids, these parents passes away and all the children live out of state, or there's the one kid that lives local and the other two are out of state and sniping at them to get top dollar, and they just want to get out of it. They don't want to go over there and cut grass. They don't want to plow snow. They don't want the neighbors complaining. And to them, you're right. It's here's the price. I can sell it quickly and be done with it a month from now. I don't want to torture myself holding on to this property for months or years, and it should be well within their right to set what price they want to sell that house for. So there's usually, in my experience, there's always another story going there, because kind of going back to my first statement, is like, I just don't know that there's that many people walking the planet willing to give away a house that's worth that much more to somebody else. But
all right, everybody. Thanks for watching or listening. That's been our podcast. This has been the None of Our Businesses YouTube show and podcast. Please tune in again next week for more business updates from an accountant's perspective. Also, please check out our sister podcast, Profitless on Purpose, where they discuss anything and everything relating to the nonprofit space. Thanks for watching. Thanks for listening. Please like and subscribe and check us back again next week. Thanks, everybody.